Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. Roth IRAs are incredibly powerful retirement savings and long-term tax planning tools. But unfortunately, not everyone can directly contribute to them. I'm about to explain everything you need to know about Roth IRA contribution limits. If you like this video, please be sure to click the subscribe button and the little thumbs up like button below the video. Before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. The main benefit of Roth IRAs is that their growth in the accounts is tax-free and distributions are eventually tax-free, assuming you meet a few qualifying criteria. To learn more about those qualifying criteria and the other conditions around taking money out of Roth IRAs, check out my other video, Understanding Roth IRA Withdrawal Rules. To get money into a Roth IRA, you can either convert money in from a traditional tax-deferred IRA, or you can directly contribute money into the account, like from your bank account. This video will discuss the limits around how much can be directly contributed to Roth IRAs. In order to make any direct contributions to a Roth IRA, you need to have compensation in the year of your contribution. Here's the IRS's formal list of what is and isn't considered compensation. Wages and salaries from employment are obviously considered compensation. Furthermore, while not explicitly shown here, severance payments are typically also included as compensation, as they're generally reported as normal wages on the end-of-year W-2 tax filing from the employer. Commissions received for products sold or services rendered are also considered compensation. Self-employed persons are able to consider their net self-employment income as compensation. Notice I said net self-employment income. That means you can't use your gross revenue. You need to look at your net taxable self-employment income after deductions for things like operating expenses, depreciation, cost of goods sold, and so forth. Furthermore, the amount of self-employment income able to be considered compensation is also net of any deductions taken for contributions to a retirement plan and the deduction for self-employment Social Security and Medicare taxes. Taxable alimony and separate maintenance payments received are also considered compensation. But notice these forms of income need to be taxable to be compensation. For example, alimony agreements related to divorce decrees that were executed prior to December 31st, 2018 are taxable to the recipient. However, alimony income related to divorce decrees finalized in 2019 or later is not taxable and is therefore not considered compensation. Finally, non-taxable combat pay is considered compensation. This is pay received by military personnel while working in a designated combat zone. Such pay is generally not taxable as income, but is nonetheless considered compensation for purposes of being able to make Roth IRA contributions. Now here's the summary of forms of income that are not considered compensation. Earnings and profits from property are not compensation. This includes income from rental properties owned. It also includes the proceeds from selling stocks, bonds, and mutual funds, for example. Similarly, interest and dividend income is not compensation. Income from pensions or annuities is also not compensation. And here's a confusing one. Recall that wages and salaries are compensation. However, those are only compensation if they're paid for services currently performed. To the extent any of your employment compensation is deferred, it's generally not considered compensation for purposes of making Roth IRA contributions. This one can get tricky. For example, bonuses paid are usually considered current compensation even though they're usually based on performance from the prior year. But they're not technically deferred compensation. If you do have a formal deferred compensation plan, such as an arrangement where you'll get paid compensation for multiple years even after you separate from service, for example, such income is not considered compensation here. Income from certain partnerships is not compensation. This one could also be a bit tricky. The IRS's intention here is that if you receive income from a partnership where you don't provide services that are a material income producing factor for the partnership, that income is not compensation, but income from other partnerships is. Finally, income you exclude from being taxable income, other than the non-taxable combat pay I previously mentioned, is not considered compensation. This includes things like foreign earned income that you excluded from your gross income. Now that you know what's considered compensation that makes you eligible to contribute to a Roth IRA, you're probably wondering how much you can actually contribute in a given year. That's fairly straightforward. For both 2020 and 2021, the maximum amount of Roth IRA contribution you're able to make is the lesser of the amount of your compensation, or $6,000 if you're under 50 years old, or $7,000 if you're at least 50 by the end of the year. As you can see, persons 50 or older are allowed by the IRS to do an additional $1,000 of quote-unquote catch-up contributions. Let's look at a quick example. Assume you're 40 years old. So long as you have at least $6,000 of compensation for the year, your maximum Roth IRA contribution for the year is $6,000. However, instead assume you only have $3,000 of compensation. In that case, your maximum possible Roth IRA contribution would only be $3,000. And then if you'll be 50 or older by the end of the year, your maximum Roth IRA contribution would similarly be limited by your amount of compensation during that year. But assuming you had at least $7,000 of compensation, your maximum Roth IRA contribution would be $7,000 that year. Before moving on, it's important to note that these maximum annual contribution limits are shared across both Roth IRAs and traditional tax-deferred IRAs. As an example, assume you have $50,000 of compensation in 2021, but you already contributed the full annual contribution limit to your traditional IRA. In that case, you wouldn't be able to contribute anything to your Roth IRA. Or, instead assume you already contributed only $2,000 to your traditional IRA. In that scenario, your maximum contribution to your Roth IRA will be limited to $4,000 if you're under 50 or $5,000 if you're 50 or older. Thankfully, this sharing of limits concept only applies across IRAs and does not apply across any employer retirement plans you may have, like a 401k, 403b, or 457 plan. Regardless how much contribution you do or don't make to your employer retirement plan, it doesn't impact the Roth IRA contribution limits discussed in this video. There's another possible wrinkle to keep in mind with Roth IRA contribution limits, and this applies to married couples where one spouse has compensation but the other does not, or at least the other spouse has only minimal compensation. In this case, if you're the lower compensation spouse, you still may be able to make the maximum contribution amount to your Roth IRA if you and your spouse are married, file a joint return, and the combined compensation of both you and your spouse is large enough to cover both of your respective Roth IRA contributions. For example, assume you have zero compensation for the year, but your spouse has $100,000 of compensation. In that case, you can each potentially make your maximum annual contributions of $6,000 plus $1,000 catch-up if you're 50 or older by the end of the year. On the other hand, if your spouse's total compensation was only $10,000, then you two wouldn't be able to collectively contribute more than $10,000 to your Roth IRAs. Up until this point, I've been referring to your possible maximum Roth IRA contributions. Just because the IRS says the annual contribution limit is $6,000, for example, that doesn't necessarily mean you'll actually be able to contribute that much, because there are income limits around how much you can contribute. Specifically, the IRS puts limits on how much modified adjusted gross income, or MAGI, you can have and still be able to make a direct Roth IRA contribution. I'll discuss what goes into the calculation of MAGI in a bit, but for now, let's walk through what the limits are for 2020 and 2021. The MAGI limits depend on your tax return filing status. For example, if you file as single, head of household, or married filing separately, with a caveat I'll mention in a bit, you can make your maximum Roth IRA contribution in 2020 if your MAGI for the year is less than $124,000. If your MAGI is equal to or greater than $139,000, you're not able to make any Roth IRA contribution. And then if your MAGI is in between those two, you're able to make only a partial contribution. The amount of the partial contribution is basically linearly interpolated between the two MAGI ranges. In other words, the closer your MAGI is to $124,000, the closer your allowable contribution is to the maximum amount. And then the closer your MAGI is to $139,000, the closer your allowable contribution is to zero. If your tax return filing status is married filing jointly, or qualifying widow or widower, you can make the full 2020 contribution if your MAGI for the year is less than $196,000. And you're completely phased out from making any 2020 contribution if your MAGI is $206,000 or more. For MAGIs in between, your allowable contribution is similarly based on a sliding scale between the two MAGI points. Here's a possible gotcha. If you're married and file a separate return, you can only use the aforementioned MAGI limits if you lived apart from your spouse for the entire year. On the other hand, if you and your spouse live together for any part of the year, your MAGI limits are drastically reduced. Specifically for 2020, if your MAGI is $10,000 or more, you're completely phased out from being able to make any Roth IRA contribution. And then for MAGIs between $0 and $10,000, your allowable contribution is scaled between $0 and the maximum $6,000 or $7,000 amounts previously discussed. For 2021, the MAGI ranges are all slightly larger by $1,000 or $2,000, except for the case of those who are married, file a separate return, and live with their spouse for any part of the year. In that case, it's the same $10,000 MAGI threshold as in 2020. Now let's discuss how MAGI is actually calculated. You may have heard the term MAGI, or Modified Adjusted Gross Income, before. But chances are it's not the same MAGI I'm about to show, because the IRS has about a dozen different definitions of MAGI used throughout the tax code. The one I'm about to share is specific to Roth IRA contribution limits. First, start with your adjusted gross income from your tax return. Next, subtract out any Roth conversions you made. That's right, Roth conversions are taxable and increase your gross income, but for purposes of determining your eligibility to make Roth IRA contributions, the IRS lets you back those out from your gross income. Next, you have to add back in any deductible contributions you made to traditional IRAs. Then also add back in any deductions you took for student loan interest payments and qualified education expenses for tuition and fees. And then there are a few other miscellaneous items of income you have to add back in that you were otherwise able to exclude from your gross income. This includes things like the exclusion for foreign earned income and the exclusion for employer-provided adoption benefits. That's how you arrive at your modified adjusted gross income, or MAGI, that you used in the previous table when determining how much Roth IRA contribution you're eligible to make for the year. Before wrapping up, I have a few other comments about Roth IRA contributions. First, there's no age limit around being able to make contributions to a Roth IRA. So long as you have compensation and your MAGI isn't over the phase-out limit, you're able to contribute to a Roth IRA. Next, you can make a calendar year contribution to a Roth IRA up until the tax return filing deadline the following year. For example, assume you want to make a Roth IRA contribution for 2020, but you're unsure of what your final MAGI is going to be, and you don't want to contribute until you know for sure. The IRS gives you until April 15, 2021 to make a Roth IRA contribution for 2020. Or, if you file for a 2020 tax return extension, you'll then have up until October 15, 2021 to make a Roth IRA contribution for 2020. The IRS realizes you may not know your MAGI until you actually do your tax return. That's why they give you those extra months beyond December 31st to make a contribution for the previous year. And finally, what if you end up contributing too much to your Roth IRA? Such as if you made a contribution early in the year only to find out at tax return time that your MAGI ended up being high to the point that you couldn't contribute at all. The IRS is also fairly generous here. They will give you up until your tax return filing deadline to take out the amount of the excess contribution and any earnings thereon. So long as you take out the excess and earnings before filing your return, you won't be penalized. So you'll be taxed on any earnings that were made on the excess contribution. On the other hand, if you fail to take out the excess contribution before the tax return filing deadline, you will have to pay a 6% penalty on the amount of the excess contribution. Now, while 6% isn't necessarily a huge amount, it's nonetheless not something you want to have to pay, so be diligent with keeping track of your contributions in MAGI. Well, that's it for Roth IRA contribution limits. I hope you found this video helpful. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes in Retirement, where you can learn all about tax-efficient retirement planning. Thanks for watching. I'll see you soon.